Net present value method. Unlike all the previous methods of carrying out financial appraisals of a project, the net present value takes account of the time value of money. To understand this concept, you must be aware of the impact inflation and time has on money. Think about this. Would you rather have £100 given to you today or in 5 years' time? Which will you prefer? I guess you will prefer to have it today rather than 5 years' time. Why? Because if you have it today, you can invest it and make more money on it by year 5. In short, £100 is worth more today than in 5 years' time because it can be invested to yield more returns by year 5. So assuming the returns on your investment of £100 is 10%. Very high return, but let's stick with this as a way of illustrating the point. What will the results be using this appraisal method? Below is the return you will earn from this investment, and you can see what £100 is worth by year 5. Note, at the end of year 1, your interest is £10, and your £100 is now £110. By the end of year 2, your interest is £11, and your initial investment of £100 is now £121. Well, with this said, you can see that by year 5, your initial capital has grown to £161. So you see, the impact of time on money is one that can make a big difference on the timing of cash flow, whether it is coming in or going out. What all this means is this: when appraising projects for financial viability, a manager must go one step further to determine the net present value in order to determine whether the project will generate a positive or negative net present value. To do this, the following steps must be taken. First, determine the projected income or sales from the project for the financial year concerned. 2. Secondly, determine the projected expenditure or costs of the project over the financial year concerned. 3. Third, determine the amount that is to be invested into the project as initial capital investment. 4. Determine the rate of interest that the capital to be invested will generate from alternative investment options. This is called the opportunity cost of the investment. For instance, if you are to invest £100,000 in a project, you have the option of investing it in a bank for a return of, say, 10%. Then 10% is the returns in percentage term that you will be losing. And by default, your project should earn more than 10% return, or at least 10% return to justify financial investments to be made on it. 5. Once you have all the above in place, you now move on to calculate the net profit or loss for the different financial year on the basis of the projection, deducting projected expenditure from projected income. And 6. You then discount all projected net profit or loss by the rate of interest that will be lost due to investment in this project. See point 4 above. The discounting process is a way of determining the present value of all future income and expenditure or net profit. In short, what the future income is worth in the present time, current time. Of course, the future income or expenditure is always going to be worth less in current time because time gives us the capacity to invest money today for future returns tomorrow. Refer to our illustration about the investment of £100. Let us now look at an example to ensure you are clear about the concept. NPV in practice. Referring to our earlier project illustration, you will see the results of our NPV computation on this slide. Now, you can see that the NPV is negative. It simply means that with discounting factor of 10%, this project yields net income that is below the initial investment of capital. Simply put, the capital of £160,000 will be better invested in a project that yields 10% or more. Now you can see the limitations of all the other approaches we have studied so far. The NPV method is a solid and sophisticated approach for appraising projects effectively. In practice, all the different appraisal methods have their place, but should be used with caution in regards to their limitations. In regards to the discounted rate used for the 10% rate of interest or returns, note there are DCF tables that can be used to extract the discounted rate for any rate of returns assumed in a project. In fact, there are calculators available in the market to do this for you, so please don't get all hung up with it. The important point is for you to understand how the concept works in practice. Conclusion. Now that you have learned most of the financial skills for effective project management, we ask that you ensure all the exercises are completed as part of this course and steps taken to put the concepts into practice as you perform the duties of your role. Do make use of our bonus materials that we have offered on the training portal, and by all means contact us for your certificate of completion by submitting by email evidence that you have carried out all the exercises on your workbook. Do let us know if you need any further assistance with any of the concepts taught in this course by sending an email to training@bssresponders.com. We do not deal with queries relating to online courses over the phone. After you have sent us an email with your questions, one of our expert tutors will get back to you within 72 hours. To improve our services, we need your feedback about this course. We ask that you complete and submit by email to us a copy of the evaluation form in the learning